Listen, the charts are flipping. The data is coming in. And right now, the United States economy is slowing down, not crashing, not collapsing, but slowing. And here's what no one's talking about. While America drags its feet into 2026, Europe is walking taller. That's right. European equities, European banks, European growth, they're gaining the upper hand. And if you're not paying attention to this shift, you're already behind the curve. Third quarter GDP in the US came in at 3.3%. Sounds strong, right? Sounds like the economy is still firing on all cylinders. But dig one layer deeper, and the picture changes. That growth? It wasn't organic. It was panic buying. Consumers rushed to buy electric vehicles before September 30th, before the federal tax credits expired. The Commerce Department confirmed it. Reuters confirmed it. This wasn't sustainable expansion. This was a deadline-driven sugar high. And now, that high is fading fast. Think about it. When you see a spike in spending, ask yourself, is this real demand or is this manufactured urgency? In this case, it was manufactured. 438,000 EVs sold in Q3 alone. A record. 11% of all new car sales, the highest ever. But here's the thing. The moment those tax credits vanished, the projections collapsed. Bloomberg NEF slashed their forecast from 48% of U.S. car sales by 2030 down to just 27%. That's a 44% reduction in expectations. And S&P Global? They think EVs won't even hit 7% of Q4 sales. That's how fast the momentum died. Now, let's talk about the government shutdown, the longest in U.S. history. The Congressional Budget Office, the CBO, they ran the numbers. And the numbers are brutal. The shutdown could slash 1 to 2 percentage points off fourth quarter GDP. And while some of that lost activity might come back over time, $7 to $14 billion in economic activity is gone. Permanently. Vanished. That's not a rounding error, that's real wealth, real productivity, erased from the ledger. So here we are, heading into 2026. Job creation is dipping. Consumer spending is cooling. Business investment, the kind that drives long-term growth, it's slowing. Invesco's market analyst Ben Gutteridge said it plainly. I've no doubt the U.S. economy is slowing. No spin, no soft language, just the reality. And investors? They're not ignoring the signs. Some of them think this slowdown feels a lot like what happens right before everything tips over. Now, let's rewind the tape. Let's bring in the history. Because if you know the pattern, you know what comes next. Think back to 2008. Before the financial crisis hit, the data looked okay on the surface. Housing prices were still climbing. Consumer confidence was decent. But underneath, cracks were forming. Credit markets were seizing up. Subprime mortgages were defaulting. The signs were there if you knew where to look, and the people who saw it coming, they positioned themselves accordingly. They moved into safety. They protected their capital. They survived. Or go back to 2001. The dot-com bubble had burst. The economy was slowing. The Fed was cutting rates aggressively. And then, September 11th happened. A geopolitical shock that no one priced in. And the slowdown turned into a recession. The people who were already cautious, they weathered the storm. The people who were still chasing growth, they got crushed. Here's the pattern. Economic slowdowns don't announce themselves with sirens and flashing lights. They creep in. GDP numbers look fine until they don't. Employment looks stable until it doesn't. And by the time the headlines catch up, the smart money has already moved. That's where we are right now. The headlines are still cautious. Slowing, but not a recession yet. That's the language. But the data? The data is telling a different story. Let's go deeper into the mechanics. Why is this happening? What's driving this shift? First, the government shutdown. It wasn't just a political circus. It had real economic consequences. Federal employees weren't getting paid. Contractors weren't working. Government services slowed to a crawl. And all of that, it ripples through the economy. When the CBO says $7 to $14 billion is permanently lost, that's not hypothetical. That's businesses that didn't get contracts. That's workers who didn't get paychecks. That's spending that didn't happen. And in an economy built on consumption, when spending stops, everything slows. Second, the EV tax credit cliff. This is a perfect case study in how policy shifts can distort markets. The government dangled a carrot. Buy an electric vehicle, get thousands of dollars back. And consumers responded. They rushed in. Tesla, GM, Volkswagen, Nissan, Hyundai, they all saw a surge. Tesla held on to 41% market share, but that's down from 80% just 4 years ago. GM carved out 15%, up from 10% a year ago. The Chevy Equinox became the third best-selling EV in the country. Why? Because it's cheap. $35,000. The new Bolt? $29,000. That's affordable. That's within reach for families trying to escape high gas prices. But here's the problem. The moment the incentive disappeared, the urgency disappeared. No credits, no rush. And analysts are already cutting their forecasts. Peter Nagel from S&P Global said it clearly. The affordability issue is going to be exacerbated. It's really going to be a sink or swim moment. Think about what that means. The EV transition, the one that's supposed to reshape transportation and energy, it's hitting a wall. Not because people don't want electric cars, but because they can't afford them. And without government support, the growth stalls. Now let's flip the script. Let's talk about Europe. While the US is slowing down, Europe is speeding up, and the smart money is taking notice. Invesco expects European stocks to outperform in 2026. Why? 3 reasons. First, the European Central Bank, the ECB. They've been cutting rates aggressively. Cutting 8 cuts from 4% down to 2%. And now they're holding steady. ECB President Christine Lagarde said the easing cycle is most likely done. The rate is staying at 2% unless there's another major shock. That's a signal. That's stability. And markets love stability. Second, banks are lending again. Across the continent, credit is flowing. Businesses are borrowing. Infrastructure projects are moving forward. Defense spending is ramping up. Governments are investing in roads, bridges, technology. That's real economic stimulus. Not tax credits that vanish overnight, but sustained, long-term investment that creates jobs and drives growth. Third, valuations. European stocks are cheaper than US stocks. And for investors looking for value, looking for upside, Europe is starting to look attractive. On top of that, the dollar is expected to weaken going forward. Invesco said it explicitly. The dollar hasn't done much in the last 6 months, but the trend is shifting. And when the dollar weakens, European assets become more attractive for global investors. It's simple math. If you're holding dollars and the euro is strengthening, your purchasing power in Europe goes up. That drives capital flows, that drives investment, that drives growth. Let's talk about the ECB meeting in more detail. Because this is where you see the divergence between the US and Europe. The ECB held rates at 2%. They raised their growth outlook. They said inflation will fall below the 2% target in 2026 and 2027 before climbing back to target in 2028. That's a soft landing. That's the dream scenario. Inflation under control, growth sustained, and rates stable. And Christine Lagarde reinforced it. She said the governing council didn't discuss hikes or cuts. They're in wait-and-see mode, data-dependent, meeting by meeting. No preset path. That's flexibility. That's smart central banking. And here's the kicker. Christine Lagarde talked about artificial intelligence. She said AI is lifting parts of Europe's economy. Investment in AI, both public and private, is growing. And most of it is coming from private firms expanding adoption. That's the future. That's productivity growth. That's the kind of structural shift that can drive long-term expansion. The OECD Secretary General Matthias Cormann said AI spending has jumped and helped counter the drag from trade uncertainty. Think about that. While geopolitical tensions are rising, while trade wars are brewing, AI investment is offsetting the damage. That's resilience. Now let's connect the dots. The US is slowing. Government shutdowns are cutting GDP. EV sales are collapsing without tax credits. Job creation is dipping. Meanwhile, Europe is stabilizing. The ECB is holding rates. Banks are lending. AI investment is rising. Infrastructure spending is increasing. Valuations are cheaper. And the dollar is weakening. If you're an investor, where do you put your money? Here's the thing. This isn't about panic. This isn't about fear. This is about recognizing the shift. The US has been the growth engine for years. The dollar has been the global reserve currency. US equities have outperformed almost every other market. But cycles turn. Trends reverse, and right now, the trend is reversing. Smart money doesn't fight the trend. Smart money adapts. So what does this mean for you? What's the play here? First, don't assume the U.S. market will keep climbing. The data is pointing to a slowdown, maybe not a recession, but slower growth, and slower growth means lower returns. If you're overweight U.S. equities, this is the time to reassess, not to panic sell, but to rebalance, to diversify. Second, look at Europe, not as a trade, but as an allocation. European stocks have been out of favor for years, but the fundamentals are improving. The ECB is done cutting rates, banks are healthy, governments are spending, and valuations are attractive. This is the kind of setup that value investors dream about. Underappreciated assets, improving fundamentals, and a catalyst in the form of weaker dollar and lower rates. Third, pay attention to the currency markets. If the dollar weakens, that has ripple effects everywhere. It makes commodities more expensive. It makes foreign assets more attractive. It changes the calculus for multinational companies. And it shifts capital flows. This isn't something that happens overnight, but it's something you need to monitor. Fourth, be cautious about sectors that are dependent on government subsidies. The EV story is a perfect example. When the tax credits disappeared, the growth disappeared. That's not sustainable. That's not real demand. If you're investing in sectors that rely on policy support, understand that policy can change. And when it does, the market reprices fast. Fifth, think about defensives. If the US economy is slowing, if Europe is stabilizing but not booming, this is an environment where quality matters. Companies with strong balance sheets, companies with pricing power, companies that can weather a slowdown. That's where you want to be. Not chasing growth at any price, but protecting capital and generating steady returns. Here's the broader picture. We're at an inflection point. The post-pandemic boom is over. The easy money from central banks is gone. Fiscal stimulus has run its course. And now, we're back to fundamentals. Growth, earnings, valuations. And in that environment, the US doesn't have the same edge it once did. Europe is catching up. Asia is stabilizing. Emerging markets are finding their footing. The world is rebalancing, and your portfolio should reflect that. So let me ask you this. Are you ready for this shift? Are you positioned for a world where the US isn't the only game in town? Because the data is clear, the trends are clear, and the smart money is already moving. Don't be the last one to figure it out. If this breakdown helped you see the bigger picture, if it gave you a new perspective on where the markets are heading, hit that subscribe button. Stay ahead of the curve. And drop a comment below. Tell me, are you shifting your allocation toward Europe, or are you staying overweight US equities? I want to hear your strategy. Let's talk about it. If you want to dig deeper into the report, check the source links in the description below. This content is for informational and educational purposes only. It is not intended as financial advice, investment advice, or a recommendation to buy or sell any securities. Always consult with a qualified financial advisor before making investment decisions. Past performance is not indicative of future results. Investing carries risk, including the potential loss of principal.